And Robert, you just point out who you are.
Sure. Justin Goodkind. I presently work for a SaaS company doing identity verification, fraud prevention, anti-money laundering on the sales side and business development. Pleasure to be here and look forward to hearing from you guys today.
Morning, everybody. My name is Robert Clamser. I am a senior managing consultant for a company called Shreddo that does case administration and technology for large corporate Chapter 11s. I started a business that was acquired by them about 2.5 years ago. And as Professor White said, I was a former competitor with Justin. I've competed in this competition 3 times. I've judged it once. So I have been in your shoes. And I know the work that goes into this, and so I'm looking forward to hearing what you guys have prepared. And as Professor White also said, I did mention this competition on television. I was a contestant on the Hollywood Squares right when I was coming out of college. And while that's a good story and a good use of this, I will say that this competition is something that's been on my resume when I'm coming out of college. And it was always a really interesting conversation starter. And I congratulate you guys for doing this. And I would encourage you to use this experience in your professional dialogue because it's unique. And sometimes when you're meeting people, when you're networking, all it takes is some kind of hook to make a really solid connection to grab someone's interest. And this is one of those things because it's so unique. So I'm happy that you're doing this. I'm happy to be involved, and I think you'll find it very beneficial long beyond today.
I think I might be the last judge. I'm Dave Basilewicz. I'm a compliance manager for Olympus Corporations. We work in the med tech and life science industry, and I'm a lot newer to this than everyone else. This is my 2nd year judging. So I will lean on the other judges a little more for their experience, but I'm happy to be here and happy to hear your guys' presentation.
Okay, just finally, a little bit about me. You may have seen the intro that I did. I'm a retired ethics officer from Verizon Communications. I've also served as Commissioner of Occupational Professional Licensing for the state of Maryland and Commissioner for the Water and Sewer Authority. With that, I will just end, and what I'll do is I will read what are the instructions for the full presentation, and after that, I'll let the team introduce themselves and we'll get started, okay? First of all, for the full presentation, in this part of the competition, you're taking on a fictional business identity and assigning a fictional business identity to the judges. Please make sure everyone knows who you are and who they are before you begin. You will have 25 minutes with a 5-minute cushion to describe the legal, financial, and ethical dimensions of a problem and to recommend a solution that passes muster on all 3 counts. During this time, teams will be uninterrupted. When you're finished, the judges will ask you questions for 20 minutes. During the Q&A, both you and the judges stay in character. After the Q&A, the judges will give you feedback outside the role playing. Some important things to keep in mind. The ethical aspects of your analysis are the most important part. However, these should be described in a simple, practical, common sense fashion. Using technical, philosophical terminology or basing your argument on religious or theological grounds will be considered a serious weakness. During this presentation, every member of the team must have some sort of speaking role. I will be keeping a timer, and I will kind of give you a 5-minute warning when your time's up or close to being up, and we will try to utilize that 5-minute cushion if you need it. With that, I will turn it over to the team, let you introduce yourself, and get started.
Great, so thanks. So my name is Thomas Colucci. I'm a senior at the University of Massachusetts, Amherst. I've actually competed in this competition virtually before, so last year. I never ended up getting to go, to Boston to do the live session and participate in the running, portion of it, which is a little sad, but nevertheless, it's been a great presentation, a great event, even in the virtual format. So I'm happy to be here again and presenting on special purpose acquisition companies. So SPACs, which was new to me a month ago when we started this process, but now I feel like we're able to provide a good presentation on it. So hopefully you guys enjoy it.
Hi, everyone. My name is Malcolm. I'm a junior at UMass Amherst. I also did this last year virtually with Tommy. Had a great time. Looking forward to going back, hopefully my senior year next year, and getting the live experience. I'm happy to be here. Thanks.
Good morning, everyone. My name is Paulette Palomares. It's so good to be here. Thank you so much for waking up at this time, especially if you're in Pacific time. And I'm looking forward to doing this whole event. So thank you.
Everybody, my name is Fiona Herskovich, also from UMass Amherst, and this is my first time participating in IBAC. I'm so happy to be here today and to share with you, along with my teammates, everything that we have learned about special purpose acquisition companies.
Great. So I think at this point, I'll share my screen and then we can get the presentation going.
Okay. So once again, good morning. Today, we are the Eisenberg Innovation Consultants, and we will be talking about strategic recommendations for the ethical implementations of SPACs. So who are you? And that is the Queen's Gambit Growth Capital, a SPAC management team. And to start us off, once again, my name is Paulette Palomares.
I'm Tommy Colucci.
I'm Malcolm Walensky.
And I'm Fiona Herskovich, and today we will be going through our presentation by playing across our agenda here, starting with our first move of our introduction, moving into ethical considerations. What is a SPAC? Queen's Gambit Growth Capital, ethical analysis, legal considerations, financial considerations, and ending with our final move of our recommendations.
So at this point, I would normally prompt you to scan this. I don't want to spend too much time. I can provide you with this QR code later. But essentially what this QR code would do is bring up on your phone or whatever device you have a website that lets you know what you would have in wealth accumulation if you were to invest $1 per day since the day of your birth. Now, I know you're all young, just like me, so maybe the results would look fairly similar to this. I actually did this earlier, and I decided, well, I was born in June of '99. If I were to invest $1 a day in the stock market, I would actually have close to $30,000. Now that's, might seem pretty good for a 21-year-old. I know that's not what my bank account's looking like right now. I wish it was, but you'll see the results could actually range, for a 40 to 50-year-old. Imagine that decimal place, one spot over to the right, somewhere in that range. So you really could see here in this graph the true potential of the stock market. And I compare this to a 2% interest rate compounded annually that, is actually is pretty good for a savings account today. As a matter of fact, I think most savings accounts would give you less than 1%. But on an average of the past 20 years, again, it still cripples in comparison to the potential that the stock market holds. So we have this great potential for wealth in the stock market today. That is essentially what I'm trying to present to you with this slide here. But there are some ethical considerations that might be hidden in the shadows. We see with this great potential in the stock market that only the top % of wealth is really taking advantage of it. As a matter of fact, top 1% of wealth holds more than half of the directly held stock in the United States. Top 10%, now they hold about 92% of total public stock. So that's almost all of the public stock that's available out there being held by the top 10% of wealth. So this is really creating, a wealth gap. And this is one of our primary ethical considerations here is contributing to this wealth gap. We want to make sure that we're actually democratizing wealth in the sense of special purpose acquisition companies. We think that there's great opportunities to do so in this SPAC trend. So again, just visually, if you were to look at the total public stock out there in the United States versus the population, we see more than half attributed to 1% of the population, the next 10% holding about 92%. So all of that left bar there attributed again to the top 10% of population as shown in the right bar. And the rest is allocated to the next, the bottom 50% of the population. So again, in a theoretical, utopia, these graphs would be inverted, right? We would see the respective wealth being held by the respective percent of population, but instead we see the exact opposite. Another underlying ethical consideration, especially today, is this idea of diversity and inclusion. We see that as a byproduct of the wealth gap, problems with diversity and inclusion still arising, especially in the startup and the entry-level market. So we see that tech startups have a notable lack of diversity. And despite all of this, as a matter of fact, the Boston Consulting Group, so the BCG, reports 20% higher innovation revenues in inclusive firms. So we see an actual monetary benefit to this idea of inclusivity, and yet firms are still not focusing on this as a crucial aspect to their business model. And last but not least, as we get into some of the opportunities that special purpose acquisitions hold, as we'll talk about a little bit later in the presentation, we want to keep in mind that this is a flexible instrument for finance, right? This is an opportunity for people to really get in on the public space, get in with public capital in sort of a flexible manner. And with this flexibility comes great responsibility, right? So the deregulatory nature of SPACs, again, open up a window for malpractice and fraud and conflicts of interest that we want to make sure that you're avoiding as a SPAC sponsor, given regulation down the line, and actually current regulation, very, very recent regulation within the past few days, as a matter of fact. So we want to make sure that you're preparing for that in that sense. So again, we're talking about the primary stakeholders as they relate to special purpose acquisition companies. So a couple key terms also involved here. We have the retail investor. So this is your average investor, your non-professional participant in the stock market. We also have target companies. So these are the prospective private companies looking to go public that SPACs typically bring into the public space via reverse merger. And then we have people like you, the SPAC sponsor. So the management teams that are actually providing this trust of wealth with the idea of bringing a private company public.
90% of startups fail. Why? Because new entrepreneurs ignore vital business processes. And SPACs can help by ensuring that new public companies are communicating, collaborating, and being transparent across all business fronts. I'm going to pass it on to my colleague Paulette now to discuss what is a special purpose acquisition company.
Thank you, Fiona. So now looking at this, what are SPACs? Where do they come from? So going into that, SPACs, also called blank check companies, are essentially shell companies set up by investors with the sole purpose of raising money through an IPO to eventually acquire another company. So a SPAC raises money and then merges with another company called also a target company. And from there, the private company now becomes public. And so SPACs in and of itself just provides more of a flexibility when it comes to going public for companies compared to the traditional IPO process. So going into where do they come from? They have actually been here for a very, very long time. And the sudden spike in popularity has come from because of the COVID pandemic. And this is because of the market right now being very volatile. So going into why they have become so popular, it is because with a volatile market, with SPACs, it's easier to pinpoint the good price range for a private company wanting to go public. So SPACs provide a really good cushioning in financial aspects for the target company. And with that said, with the management team in SPACs, they work a lot more closely with the target company. So it allows for a good inclusion and diversity to be promoted throughout the whole company in and of itself, between SPACs as well as the target company. So now looking at who is getting involved, you have Colin Kaepernick, you have Alex Rodriguez, you have Shaq, who all have started their own SPACs. And then on the other hand, you also have other companies like DraftKings and WeWork that have also become public through SPACs.
So at this point, you might be thinking about what the SPAC process looks like, right? As compared to the traditional IPO process, okay? So like Paulette was mentioning earlier, there's been this great uptick in SPACs because of the flexibility that they offer. So what does that flexibility look like? Well, from the forefront, a group of people like yourselves, you know, the SPAC sponsors have to come together and decide, okay, you know what? I think we should create some sort of money cushion that's available to bring some private company that's out there that's worthy of public funding into the public market space, right? So the start of it all is forming the SPAC team, right? So you forming Queen's Gambit Growth Capital, that step you've already taken care of. You've also taken care of this second step here of IPOing, right? Once you've decided that you want to create a SPAC, you would then go to the SEC and say, we're a group of team members that would like to file for an IPO. Actually, SPACs offer across the board IPO at $10 per share. So it's just a question of market capitalization at that point. And you've already done this. You already have two. Actually, one. You're in the process of getting your second ticker on the stock exchange for your SPACs. So this is about where you're at right now. So you are currently searching for a target company, a private company that's worthy of public funding. Now, as a SPAC, you have legally 2 years to find this private company. January of 2021 was the date of your first ticker being listed on an exchange. So you still have some ample time to do this. And we want to make sure that you're doing this right? So after you find a target, you're actually going to hold a shareholder vote. So whoever has invested in your SPAC will get the opportunity to vote on that private company and whether they think they are a worthy company of bringing public. And last but not least, should the shareholders vote yay, then they will have the option to withdraw their investment if maybe that wasn't what they wanted initially, or they can retain their shares in the newly acquired public company. So this is also called a de-SPAC. So this is the de-SPAC acquisition process. And we compare that to the traditional IPO process, which Fiona will go into a little bit more detail in here.
Yeah, so what really is the difference between a traditional IPO process and a SPAC process? So first off, foremost, the traditional IPO process is going to begin with the private company undergoing an audit with the SEC. It's going to write a prospectus, and then it's going to apply to the stock exchange. Whereas with a SPAC process, it is the SPAC sponsor that is applying to the SEC and asking for an IPO in the form of a SPAC. And the main difference here, to really highlight the distinct difference between an IPO and a SPAC, is that a private company undergoing the traditional IPO process does not have that money cushion, that financial support, doesn't have prior public funds, the same way that a target company will receive the trust of a SPAC once it goes public. So SPAC is going to have a little bit more of that financial cushion to give to that target company. So if you are a company standing on the road of trying to go public and you're at this fork in the path, you have a SPAC versus an IPO. What really is the difference? You have an IPO, and that's a company looking for money. And then you have a SPAC, money looking for a company. And speaking of SPACs, let's talk about you, Queen's Gambit Growth Capital, your members, your mission, and your motives. Who are you? Who is Queen's Gambit? You're a SPAC run by an all-female management team led by CEO Victoria Grace. Your ticker, GMBTU, was established January 20th, 2021. And this date is significant because since then, GMBTU has raised $300 million. And the purpose of this sponsor company being created is because you want to acquire a target company that promotes sustainable development, economic growth, and prosperity. And you have been doing so well that GMBTU, the second, if it goes through with the SEC and abides by all regulations, will end up commanding a market value of $375 million. Obviously, you guys are doing something right, but what exactly are you doing? The first, you're embracing and fulfilling diversity, equity, and inclusion guidelines. The second, you're staying ahead of prospective ESG reporting requirements. In other words, you're staying ahead of the regulatory curve. The third, encouraging sustainable business practices by pursuing target companies that are sustainable in and of themselves. And the fourth, you're providing expertise and maintaining professionalism across the board of your SPAC. And now my colleague Tommy is going to go into what are some failures that SPACs can fall prey to.
Yeah, so you might be thinking, wow, what a great thing SPACs are, right? So it almost seems like a for sure investment, right? But again, there are concerns that we have that need to be addressed for other SPAC sponsors. We know that you guys are doing the right thing. Queen's Gambit currently is doing the right thing, right? You're looking for, you're standardizing this idea of diversity and inclusion. You're looking for sustainable companies. You seem to have best practices embedded in your work environment, right? But there are some failures, and we want you to be aware of these failures moving forward if you seek to pursue a future in special purpose acquisition companies. We know that SPACs can only operate on a timeline of 2 years. So what we see is that a lot of special purpose acquisition companies might not be necessarily looking for the best company to acquire, but just any company to acquire, because we can see that they can be fairly lucrative for the SPAC sponsor, and it might not be in your best interest as an investor to be submitting to money to a SPAC sponsorship team that's not looking for the best, but just anything, right? And we've actually seen this with some celebrities that are just really looking for a payday in some of their SPACs that they're forming, as opposed to actually building a management team that can provide value not only in a monetary marketable sense, but also in a fiscal and regulatory sense, right? So we've seen companies like TGI Fridays and Chuck E. Cheese's that have actually attempted to go public via SPAC, but there were not the proper precautions in place that prepared these companies for the public market space. Because once you submit to the public realm, now you are submitting to an entire booklet of the SEC's regulatory considerations. So that is something that most private companies going public actually fail to look deeper into. But of course, there's advantages, right? So there's advantages to the retail investor. They offer a unique opportunity for retail investors to get involved in the entry-level market, right? So typically in the traditional IPO process, it's normally the professional and the seasoned investor that really is able to get involved early on. SPACs offer a chance for the everyday participant in the stock market to get involved early on. Of course, there's advantages to the target companies, right? So being a private company, of course, has its benefits from a regulatory perspective, but from a fiscal perspective, it's really, really easy to raise capital in the public space. So using SPACs as a flexible way to become public provides great opportunities to the target company, as you can imagine. And of course, it provides opportunities for you as a SPAC sponsor, right? We look at this example here in a SPAC with a $100 market cap, say for instance, if you are a SPAC sponsor, it's standard that you're responsible for about $3 to $4 of that investment. But upon negotiations with a target company, it seems that you'll receive about, again, on standard, about $20 of that common stock. So we see across the board, this could be very lucrative for the SPAC sponsor. If your basis in the investment is only about 3 to 4%, and at the end of the day, you're receiving about 20% interest, as a SPAC sponsor, you could see monetary benefits tenfold come out of this process. So we have preliminary recommendations, and at this point, I'll pass it back to Paulette to talk a little bit about those.
Great. So going into the preliminary recommendations, we have this four-pronged approach to establishing the best practices for SPAC sponsorship. And those four little sections that we have is one, you need to create a team with professionals that can address current pending regulatory concerns. Then you also need to establish a standard for diversity and inclusion in target companies. Going forward, properly disclose company dealings with the SEC as of a traditional IPO. And of course, at the end, take a lead, take an active role in developing appropriate regulatory regimes.
When we first started drafting the best practices for SPACs, we took an ethical analysis approach first. So let's talk about the duties that a SPAC has to its stakeholders. The first, retail investors. Again, these are non-professional participants in the stock market. What are the duties of a SPAC to these individuals? The first, creating opportunities for wealth for the average person. The second, properly disclosing relevant financial information so that these individuals are making sure to invest in places that are transparent. And the third, SPACs are trying to help aid in societal and innovation and growth so that retail investors can take back the stock market from the 1%. The second duty that we have here are to start target companies. And these are the prospective companies that are seeking to raise capital via SPAC. What are the duties to the SPAC? What are the duties of the SPAC to the target company? And the first is promoting ethical business practices. And this goes right in line with maintaining compliance with the SEC. And the third, creating a culture of diversity and inclusion. Like my colleague Tommy mentioned before, companies that are diverse oftentimes increase revenue streams. So SPACs definitely want to tell target companies and show target companies how to be diverse and how to be inclusive. And the third stakeholder that we have here is you. What are your duties? So your duties as a SPAC sponsor is to preserve the flexibility that SPACs offer by making sure that you're not going to prevent the SPAC bubble from popping. And that means respecting the guidelines and considerations of SEC. And also the third, growing wealth. In the end, your SPAC is going to help fund a public company. It's your responsibility to make sure that you're following the ethical guidelines that will enable you to do that. Moving on to our outcome-based analysis. So this is the best for all parties involved. So on the one hand, we can not use SPACs at all, which would mean the retail investor would have no access to the opportunity. The target would be limited in accessing the public market as quickly. And this idea of democratizing the market would not happen because we wouldn't have SPACs at all. And on the other hand, we can use SPACs, but we won't follow any ethical recommendations, which inevitably would lead to SPACs being regulated out of existence because this whole framework stands to fall apart if we don't respect ethical guidelines. So we need to hit this nuanced approach here where we are using SPACs, but we're doing so in a way that respects ethical considerations. Now my colleague Malcolm is going to talk about legal considerations.
Thank you. So moving ahead to legal, it's always really good to have 6 pillars of corporate governance in mind when you're thinking about these things, and really baking that into your target and your process, and really taking a leadership role. And then moving on, talking about these conflict of interest arise. So during the de-SPAC process, we see conflicts of interest arise specifically between sponsors and shareholders. And there's an emphasis on that. And these could actually be breaches of the duty of care and the duty of loyalty, which are both corporate governance state statutes. And you have obligation to not break these laws. And so you really want to take a proactive stance in managing conflicts of interest as they arise throughout the whole SPAC process. For the timelines like long and things pop up and there's conflicts of interest, incentives, whatnot that they need to be disclosed to the investor. Moving forward, also talking about SPAC transparency, specifically how that transparency translates to the Corporate Transparency Act, which requires reporting companies so that your traditional LLCs, corps, to register beneficiary ownership information to a U.S. Department of Treasury. This is to eliminate bad actors and fraudulent behavior. And SPACs are actively right now exempt from this CTA law, but regulations here and it's coming, and the new SEC administration has already had sent statements out. And so we recommend being transparent now, getting ahead of that regulatory curve to avoid those costs and avoid those time to cut that down. And moving forward, what are the risks of the failure to disclose from a legal perspective? So you got the first company sort of liability, which is huge settlements with the SEC, 115 million with this Bank of America Merrill merger post 2008. But that's just the tip of the iceberg. There's sort of a scaling of punishment that occurs, that it's not even just the settlements that are punishing financially. It's also the class action lawsuit potential, which is 2.43 billion in this case. So it's serious penalties moving forward. There's also a sort of an individual liability. So this SPAC sponsor, Gordon here, was found negligence of improper disclosure. So he was misled investors on information about the target, and they could actually bar you from the industry. So this gentleman here was suspended from the securities industry, and it really is punishing at an individual level as well, which violates Securities Act laws. And moving forward, the last way, we're not too worried about this for you as Queen's Gambit growth cap, but a criminal prosecution, there's jail time. These are really serious punishing moves, but definitely something to consider. So moving forward, talking about forward-looking statements as they relate to SPACs. So the private securities litigation reform, there's some protection, but again, the language is ambiguity for SPACs, and there's probably going to be pending litigation or regulation, excuse me, there. And we have to be ahead of that curve and take those costs into consideration. And finally, we're going to talk about, moving forward, some SEC comments and just under Sarbanes-Oxley Act. Just it's always, you really want to be in compliance and have a robust full compliance system early to get ahead. It's essential for negotiation. Yeah, thank you. I'll pass it on to Tommy to go into a little bit more about SOX and financial considerations.
Yeah, so Sarbanes-Oxley Act of 2002 really presents some financial considerations, especially in the SPAC realm, right, or in the public space as a whole. Already. So again, like Malcolm mentioned, Sarbanes-Oxley Act, they have presented a number of legal considerations in the public space, but also financial backdraws. So we see that 25% of executives actually considering SPAC transactions are very hesitant because of these SOX 404 concerns, which are particular to the internal controls over financial reporting. Okay. So Sarbanes-Oxley actually exempts this requirement for companies with less than 75 million in public float. But in the private space, this becomes a major concern for companies moving forward in the public, in the SPAC process, right? Becoming a public company. So from a monetary perspective, if you're a smaller company, right, a startup generally looking to go public via SPAC, you probably fall in somewhere within this range, right, where you're having revenues of less than 100 million, between 100 million, 500 million. That's the typical startup looking to go public. And we see almost half of your revenues, in order to conform to SOX 404 standards, are going to be towards your internal controls over financial reporting, right? So this is a major financial concern. In order to maintain compliance with this, it's very expensive, especially comparatively speaking with smaller companies. It gets more expensive as you grow larger, but in terms of percentage of revenues, we see that it's less of a concern for larger companies, right? Larger companies can take this hit, but the smaller startups looking to go public in the entry-level market, this is a major concern. Another cost is, of course, the cost of non-compliance, right? If you kind of have this non-filtered approach to special purpose acquisition companies, right? It's really this unique opportunity to grow insane wealth. But if you're not taking the proper steps and you're not compliant with the SEC, you could see that it could pose some detrimental harm financially. We see that the SEC imposed penalties of about 4 billion to non-compliant firms in the year 2018 alone, right? And this number is only growing. We see that year to year, the cost of non-compliance is getting more and more expensive. So we want to make sure that you're taking the right steps in order to maintain compliance with the SEC, which leads directly into our recommendations for best practices. So again, Paulette mentioned our 4-pronged approach to doing this the right way, to making sure that SPACs are around for years to come, right? Because this provides a great opportunity for you as a SPAC sponsor, as well as retail investors and target companies in the future. So we have this approach of create, establish, disclose, and lead, which Paulette touched upon a little bit earlier. We're going to go a little bit more into detail on what this means exactly. Starting with create. You want to create a team of professionals with actual business expertise, right? We see this trend rising in a lot of celebrities, and of course they bring great marketable value. But we must question, what value do celebrities truly bring from a regulatory perspective and in the perspective of, again, accounting and financing and maintaining effective internal controls that might not be, on the bucket list of somebody that plays basketball for a living, right? So we want to make sure that you're prepared as the SPAC sponsorship team. You actually have individuals that provide this type of value to private companies being brought into the public space. I'll pass it to Paulette now to talk a little bit more about our establish approach.
Yeah, it's also really important to establish diversity and inclusion within the SPAC sponsor and the target company. As we have already mentioned, diverse teams within the business realm are commonly more successful because of there being more diversity in thought, which then allows for good communication. If you have multiculturalism, if you foster multiculturalism in your company, that allows for, once again, diversity in thought, which pushes forward ideas, allows for a more successful environment, which in result, if you have a SPAC investing in a team, investing in a target company that wants to foster diversity, it means that it's investing in something that will likely be successful. And also in a monetary sense, it also provides for a more diverse teams bring up revenue as well. So in general, it's important to establish that.
Yeah, and moving forward to the disclosure piece of our recommendation, regulations here and it's here to stay. Just yesterday, the new SEC director, Gary Gensler, was confirmed, and he is going to have some harsh, look more closely at SPACs, and just being able to follow the rules, provide accurate and disclose information to investors. It's really important to do that because regulations here and the cost of non-compliance is damaging.
Lastly, it's not enough for only Queen's Gambit to be taking an active approach. We want to make sure that SPACs are taking an active role in developing appropriate regulatory regimes. Queen's Gambit, we want you to advocate for and follow the best practices for SPACs, as well as be a leader in the investment industry to relay to investors the reliability and credibility of SPACs, because the ethics of today are the laws of tomorrow. Thank you so much.
Thank you. I was hoping that everyone could see me as I was giving you the time signals. I'm still trying to work this out on my screen, but you did a very good job, and I think you stayed within the time requirements very well. At this point, I will turn it over to the other judges. I'm sorry, to the rest of the board. I've got to stay enrolled and have them to ask you some questions about your presentation.
I'll kick it off. Thank you guys very much. You don't know this, but we were doing our research, and we know that a group of your friends, some of your best friends, we were looking at their company, UMasters Inc. And we at Queen's Gambit are very seriously considering acquiring 100% of your best friend's company. How do you advise them, given everything you just told us about the ethics of SPACs?
Yeah, I don't mind taking this one off. So our best friend, we think that their company, considering that we're friends with them, is participating in an ethical realm already. And as the SPAC sponsorship team, as Queen's Gambit, especially, that you're looking for companies that has of course, a creative and innovative space, but also an emphasis on diversity, inclusion, and sustainability, right? So our best friend's company is we think that they're participating in those practices already. We think that they have a company that does this already, but our recommendation to them would just be to emphasize that, right? Emphasize their role not only to their investors, but their role to a society as a whole. and how it could also pay off acting ethically, having an emphasis on diversity, inclusion, and sustainability can pay off in a monetary sense, especially as we see pending litigation and pending accounting around this space down the line. So our recommendation again to them would just be to continue doing what they're doing and really make sure that they emphasize this in their negotiations with you as a SPAC sponsor, that this is something that's here to stay, that this commitment to diversity, equity, inclusion, and sustainability is here to stay, as it will build a better tomorrow.
And to add on to my colleague Tommy's point of view, it's also important for a SPAC, if they are planning on acquiring a certain company, they need to talk to their investors beforehand. Investors are a vital role in the process of transforming the SPAC and funding a SPAC. So before the SPAC actually goes through the de-SPAC process, they need to have a conversation with their investors. So I would also recommend that the SPAC have that conversation, be transparent. Like we've said in our presentation, making sure to maintain that transparency across the board will only increase the credibility of SPACs as they move forward.
So I'll jump in. I have a question around diversity and I guess what it means to this company. Are we focused on race, gender, experience, the products we're selling, the customers we're trying to retain? You know, what does this actually mean when you analyze a potential investment?
Right, I can take this one. That's a very good question. So when it comes to diversity, one of the things that really creates a tight-knit community is not necessarily things like gender, race, anything like that, nationality, anything like that. What makes something a tight-knit community to where people feel included and feel at home is that aspect of diversity in thought. Diversity in thought is open-mindedness, being respectful of everyone, being connected. It's once again fostering that corporate culture, which is so important within companies right now. We see it right now with Netflix, and we see it right now with a lot of other companies that are trying to foster that good corporate culture. And so when it comes to diversity in thought, usually that is what kind of, you see that connection when it comes to race and when it comes to gender. That's where you start seeing that there's diversity in thought, because people have already done those experiences because they have many different backgrounds. And that's what usually brings forth a lot of diversity. But all in all, what the root of it is diversity in thought and having people be accepting in the aspect of like being willing to learn, being willing to think of new ideas and embracing everything that is with brainstorming. That is what truly creates a diverse feeling within a company.
So real quick, I'm gonna jump in. Let's boil that down a little bit more. So are we ranking these potential investments as being more inclusive or less inclusive and only choosing what's deemed to be the more inclusive option?
I would say in the context of this presentation, we're using a similar definition to diversity as the Boston Consulting Group. And we're also filtering our potential investments by the definition provided by that study. So again, like Paulette mentioned, we have this idea of age, gender, and country of origin and nationality to be on the spectrum of diversity. But we also have, like Paulette mentioned, this idea of diversity in thought, right? So not necessarily what you look like and who and where you come from, but what your background is academically, right, in the experienced space. So all of these components make up this idea, this definition of diversity. And on that front, we are in fact recommending that you filter companies' potential investments on those premises as well. You need to be taking that into account.
So let me push back a little bit more, because I think we need a little bit more advice. Let's take your friend's company, because obviously, you know, we're working with a $300 million fund here. What do you think? We have companies that we know are we've vetted them for their diversity and inclusion principles, and we rank them really high. And then I have another option that are going to make a lot of money, and we rank them really high. And the diverse company, I don't see the returns there. What do you think we should do do we need to deploy some of our funds to a company that ranks higher on the diversity score, or just the pure financial score? And I'm not saying that this other company isn't ethical. We vet companies for their ethics, but I've got a really great and diverse company, and then I've got a home run that I know is going to pay for all of our kids' college and maybe even their kids' college. Tell me what to do.
Right. That's a really good point. When it comes to diversity and anything having to do with such grays, because obviously we don't live in a world that's black and white. We live in a world that has a lot of grays, and we encounter a lot of those situations many a times. So with those, it's almost like playing it by ear. Once you have come down to your two possibilities or possible target companies that you can have, that's where you would have to, that's where playing it by ear comes into play. So if at that point, both of them can foster good opportunities for you, but you think you can work better with one or the other in regards to communication, you have a better relationship there, that's when you try and find those little details that can tip the scale. So diversity is more of, it's really great to have diversity, and most of the time, many companies nowadays have a little bit within it. So if one company, for example, the one that is can provide you with more revenue, if you want to create a better communication with them to be able to foster more diversity in there so you can have best of both worlds, you can do that. And for the other way, you can try and work either way. So it's a lot about adapting to the little things, because at the end of the day, communication is key. So that's what I would suggest.
In addition, it's also important to kind of go back to this original thought that I said beforehand, but it really is up to the conversation that you have with your investors. Which way do your investors want to go? Ultimately, it's their money. So what's important to think about here is if you do end up wanting to go with that financially more profitable option, our good friends here, you can also think about the fact that there's another reason why companies are looking to go public with SPACs especially, and that's because they get an advising team of professionals. At Queen's Gambit Growth Capital, you guys personally have the DEI requirements and regulatory guidelines that target companies are looking to acquire themselves. So you can provide an excellent example to that company so that they can help to foster those guidelines as well.
Switching gears a little bit here, we've talked a lot about wanting to provide more transparency and more capability for retail investors to participate in these type of investments, meaning that the bottom 50% of the market who traditionally doesn't invest much in equities has that opportunity. Obviously, as a SPAC, it's part of our capability, it's part of our strong suit to not exactly publicize who our target company will be until it's all locked down. So how do we provide an opportunity for a retail investor to actually get in at the ground floor and have that opportunity to make money if they don't really know what they'll be investing in ahead of time?
I can add on to this one. So you're right that the investor might not know what they're investing in right then, that 2-year period of search for a target. But as an investor, you want to look for a competent and capable management team, because that's what you're investing in, and you're putting your money in their trust to find a good target. And if you don't like that, then you can get out. Once the target has been acquired and the SPAC has been found, the investor has the opportunity to add more, like invest in that de-SPAC process. They have an opportunity to invest more in the company. I like this target. I like this management team's decision. I want to put more money into it. But you also have that option to take the money out and say like, okay, I don't like this decision that management has made. I want to pull back a little bit. So that flexibility is what the investor and the retail investor is investing in, is the more autonomy of decision making with their own money that traditional IPOs did not provide previously.
So on that same note, if we're talking about the lower percentage of wealth right in this country, we're talking about those retail investors. Most of those retail investors are not going to be educated investors, right? They're not going to know much about the management group that they're investing in. They're not going to know much about all of this sort of this option for them. So what is our responsibility to educate them on both the benefits and the risks of SPACs generally, right? And then to say, before you even invest, here's why we suggest you go this way. Like, how much of this is our responsibility? Because if we take that on, that is a lot of work. That's a lot of, people hours going into that, a lot of responsibility. And then that also puts us on the hook to say, we've made certain promises to these people. So how much do you guys think it is our responsibility to educate these retail investors who may have no idea kind of what's going on here?
Yeah, no, that's a great question. I can hop in on this. So, of course, as part of our recommendation was disclosure, right? So keeping, again, your investors in the loop. And as mentioned previously, omittance is a form of misrepresentation, but also leading directors and investors rather in the wrong direction is a form of misrepresentation, right? So we want to make sure that you, as the SPAC sponsor, in your communication with the investors, you're being truthful, right? You're saying, hey, look, there are risks, just like any investment, in putting your money with us as a SPAC sponsor and entrusting us to find a worthy private company looking to go public. But we believe that risk is mitigated with our recommendations, with the fact that you are creating this management team, both that's diverse in experience and diverse in culture, right? We think that both provide benefits monetarily for you as a SPAC sponsor, and ultimately as a culture of a target company looking to go public. So we see a trend, again, especially recently, in companies shifting focus in this DEI, sustainability, diversity, and inclusion space. And we want to make sure that you're on top of this as a SPAC sponsorship team. And then that those dealings, again, like you said, Dave, are communicated properly, not misrepresented, again, to maintain compliance with disclosure requirements with the SEC. We want to make sure that you're telling your investor truthfully what it is that you're looking for. And I think with time, your experience and your investments will prove that this is the correct route to take. So if you're just a lay person, you're a non-professional participant in the market, what you're investing in is the trust, is the ability of and the experience of a SPAC sponsorship team like yourself that has these checkpoints in place to make sure that you're doing this the right way.
Let me wrap it up for you, right? Let me wrap it up right now with one last question. And that is, you talked a lot about SPACs and compared them to IPOs. Did you take a look at how we at Queen's Gambit compared to other SPACs and where we stack up there? And just give me a little short something on how we stack up and what we could possibly do better in terms of competition against other SPACs.
Yeah, I can take this one. So something that you guys are doing phenomenally well is that not only do you have a team of investors, of seasoned professionals that understand the investment industry, you have a business that you've created here. You have accountants, you have lawyers, you have investors. You are diverse not only in thought and not only amongst age, gender, nation of origin, but you are experienced in a wide variety of business fields. And when a target acquisition company is lucky enough to be acquired by you, they will have access to a wide variety of business fields and business professionals that can help them amongst their variety of business processes. And like we said in our presentation, 90% of startup companies fail because they don't understand this ability for companies to have to advocate and communicate and collaborate across those business processes. And a SPAC that is as diverse as yours in terms of experience and professional experience is going to provide that target company with the necessary diversity and inclusion in business processes experience that will make them successful in the public market.
Thank you very much. And I'm going to close questioning right now and just have the judges give you some feedback. And I'll just start by saying very briefly, I think you all did a fabulous job in terms of the details of SPACs, how they compare. Your presentation was very smooth and professional. And I commend you on that. And I'll let the other judges comment from here.
I can kick it off, sure. I agree that the presentation visually, what you guys prepared, the slides, you used your slides very well. The way you kicked it off with that QR code, that it caught my eye and I was really dug in and I wanted there to be more. I do think you missed a little bit because you kind of over explained, and I almost wish you would have kept in character by saying, like, hitting us really hard with that, because it was interesting. And I've seen enough of these that most people miss that hook at the beginning. And I was excited that you guys had a hook there. So I was still intrigued there. And I actually think you could have kept in character and hit home even harder. I thought you were really balanced with your presentation. Everyone spoke. I was impressed that you very seamlessly handled the Q&A afterwards with different people talking, that you weren't talking over each other. And in this world that we've seen over the last 18 months, the fact that you guys can do that so successfully and seamlessly is really impressive, because, you know, when Justin and I presented, we were standing next to each other and we literally had physical cues for who's going to take a question. And you guys didn't have that. You never looked disorganized. So I was really impressed there. The feedback I would give, just in terms of the content of the presentation, was I think we all wanted you to go a little bit deeper in some of the topics. We were trying to pull a little bit more analysis out of the ethical issue there. I think you did a really good job explaining SPACs at a high level. And I think had you drilled into a little bit more analysis and really put on the consultant hat that you were wearing to tell us, like the question about money versus diversity. That's a really interesting ethical question. The idea of celebrities, because you kind of you glossed over that, celebrities involved in SPACs, because it's not a professional management team. But I think in this day and age, there's a lot to be said about the influence and the reach of celebrities and their involvement. And there are celebrities who are doing fantastic things in the business world. You look at what LeBron James has done for his community. You look at what Patrick Mahomes is doing. I would make the argument that those are tremendous assets to have involved in a company. But then on the flip side, you can say, well, what about some of these other celebrities who appeared for half of a season on The Bachelor? Should we be supporting them via a SPAC? That would have been a good angle to dig in a little bit more. But like I said, it's such a broad topic, and you really did understand the topic. So that was great. And I think that if you had the chance to rework this, or when you're thinking about your next presentation, your next venture, once you have that mastery of the topic, think about where you really want to dig deeper.
I think, Justin, you're on mute.
Sorry. I'll go in talking about diversity and inclusion. So it's an obvious kind of buzz topic right now. People are talking about it consistently. And really any good or sensible business knows how to deal with this, knows what it means, knows good from bad, and knows what they need to consider. But in thinking about that, DEI is not a standard. It's constantly evolving. So simply defining what it is today through your presentation, certainly helpful to bring it as a top of mind topic. But I needed you guys to go quite a bit deeper as to what it actually means. What are your recommendations specific to a potential investment? Give me some positive investments that have taken place that had a focus on DEI, as well as some companies who were invested in where it was obvious they didn't have that DEI component, and how that impacted them long-term financially, from any number of perspectives. I think it's really important to not only just talk about the issue, because that's easy, anybody can do that, but really define it as a means to defining what your company stands for, how it approaches investments, and really how that impacts people's money long term. Because at the end of the day, that's all that matters as it relates to a SPAC. How are you making people money, and are you doing it the right way?
Yeah, I'd like to add one last piece. I thought that when you started to talk about the 6 pillars, that was a very important part, and especially since this is a business ethics competition, if you could drill down a little more on that, take the previous judge's comments about dollars versus ethics, and maybe fold that into drilling down on those 6 pillars, I think that you will be homing in on what is really being looked for in a business ethics competition. Again, you had a wealth of information there, and I just want to make sure that going forward, you don't spend quite as much time on the financial piece and take as much opportunity as you can to drill in on the ethical piece.
Yeah, I'll just kind of echo what some of the other judges have said. I thought it was a very well prepared and very well delivered presentation. Just in comparing them to other ones that I've seen, I think like Robert said, you guys were very clear on, who was the person to answer specific questions, who was sort of the content expert, and you didn't interrupt each other or, contradict each other. So that was really good. And jumping on Justin's point a little bit, I think there are a lot of companies that will talk about how diversity is important to them, and not just on the SPAC side, but even companies that go through the typical IPO process, right? So it'd be interesting to see sort of a little bit more of a comparison, because there are a lot of companies that'll talk about it, but not actually implement what they're saying, right? If you guys can show a little bit more specific comparison, between companies, SPACs that are doing it versus, companies that are not doing it, why is the SPAC different from the typical IPO process, and how they can, encourage and cultivate diversity better than a company that's going through the IPO process, because there are companies that do it, but what we want to say is we are better at it, right? So it'd be interesting to see a bit more of a comparison there. And then the last thing that I had noted, which I liked that you guys touched on, sort of the wealth inequality in the stock market, but I didn't see as much how SPACs can really address that. I know that retail investors can use it as an opportunity, but there's no saying that they can't invest their money somewhere else, right? And there's no saying that wealthy people, once this company goes public, can't also invest here, right? So I would have been interested to see a little bit more about how SPACs can actually address that wealth gap within the stock market. But otherwise, I think it was a really, really good presentation. And I also agree that I think you guys did really well with the on-the-fly answers to the questions at the end.
Okay, I think we have about exhausted all of our time. I want to thank you again for your presentation. I think it was very professional. Your responses to our questions were very good. You were extremely smooth in handing off to one another. So I encourage you to go forward, and just remember that as you go forward, the next steps in the 10-minute and the 90-second are going to look very strongly at the ethical aspect in terms of the amount of credit that you get for that. So keep that in mind. It is an ethics competition. The financial and the legal aspects are very important. We don't want you to abandon them, but remember where you're going to get your most bang for your buck. Okay. Thank you very much, and good luck going forward.
Thank you.
Thank you,
Great
guys.
job,
Thank you so much,
everyone.
everyone.
Really good job.